Hi guys, today we will discuss short strangle. Now if you remember my old lectures, I told you that a short strangle is basically designed to make good money on premiums. That is your paid upfront premiums. That is your max profit. And your loss is when the price moves outside your band that you create from the strike prices of put and call options. So you need the price to stay within the band, because if it goes outside, you start to increase your losses, and your losses can be unlimited. But with my plan, you have a chance to make good money. Now how do we make that? Now as you can see, the price is outside the Bollinger Band, so it's rising. Now if it is rising, we cannot simply put in a short strangle. We will wait. Okay, now just look at it here. This is the top Bollinger Band, this is the bottom Bollinger Band number. This is top, right? Right here, it's 1812, 1816, it's rising. 1818, 1819, and 1819, 1818. This is the first day it has contracted. This was 1818 and this is 1816. This is the second day it has contracted. On the second day, you will initiate your short strangle. Now the thing to note, you are initiating the short strangle and you are paid upfront premiums. So you initiate the call option right here and you initiate the put option on this price. Why? Because if you look at it, this is above the Bollinger Band and this is on the Bollinger Band. Why? And we can adjust it accordingly. We can be on the Bollinger Band or above it. We can be on the Bollinger Band or below it. But never up. I won't suggest you go up. Even if you go up, then it would be only 5, 7, 10 cents. 15, 20 cents could be enough, but not higher, because then the risk gets increased. So the thing is, these two red lines acts if the price stays in between, we get to keep a full premium. Let's say you were paid $0.15. Let's say you were paid 15 cents on this put contract as well. So you are paid 30 cents. That means 30 cents, $30 upfront profit on one contract. If you buy 10 contracts, it's a $300 profit. But if the price moves below these points, you start to get losses. And if you don't act swiftly, then your losses can be unlimited. So look closely at what I am about to tell you. They will help you a lot to use the strategy and make good money. Number one thing to note is the time spread lecture that we discussed. Through time, example, we have paid 15 cents. So after 5 to 7 days, the premium paid 15 cents will start to get reduced. 14, 13, 12, 10, 8, 7, 6. So if after 15 days you just square them out, that is, you have sold these options, right? If you buy these options and today it's 15 cents, but after 10 days, let's say it was 8 cents. So you get to keep the difference, 8 cents into your pocket without any problem. And if it ends within within the band on the 30th day, you get to keep all the profit without any problem. So now let's see what happens next. First day, wait a minute, I forgot to put the mark. This is our trading day. This is first day, second, third, fourth, fifth, sixth, 7th, 8th, 9th, 10th. Now the thing to note, it still got contracted. The Bollinger Band, the lower Bollinger Band. Right here, this is the lower Bollinger Band number. So right on the first day it was 1636, but on the 10th day it's 1717. So it has really contracted. The same way on the top Bollinger Band. Right here, this middle number is the top Bollinger Band. So right here it was 1816, but right here it's 1798. So it is contracting on the 10th day. 11, 12, 13, 14, 15. On the 15th day, look closely. It has gone below the Bollinger Band, which tells us that the trend is now downward. Now on this day, as you look the chart every day, on this day, you would note, okay, this is a real problem. The price can just move into the trend downward and give me a huge loss. All my 15 cents, that is 30 cents in total, will be lost. I won't be able to keep that $30 profit initially made. So what should I do? On this day, you will simply square your options. How many days it has been? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So after 5 days your options would be expiring. But you won't wait till that day. You will simply buy the options right today. Why? Because if it was 15 cents initially for the premium, right here it would be 7 or 8 cents. So you are still getting a profit of 15 cents without any problem. And you'll be squaring it out because you know it's a dangerous situation. Now let's see what happens next. 16, 17, 18, 19, 20. Now it did close within the band. I was wrong. I should have waited for it and you would have got to keep the full cents. But my concept is never risk beyond your control. If the price says on this day it's wrong, square it out on this day. Don't wait for it. Because if it would have gone down, you would have got a loss. But even on this day, you got to keep a 15-cent profit. No problem. Now let's see what happens next. It still remains straight. But eventually it does go down. See? So what we were predicting here didn't happen within the next 7-10 days. But it did happen. So you won't be lucky all the time. Therefore, always remember it. Square it out right here. Don't wait for the fall. Because basically you are trading for profit. You're not trading for losses. Losses are not your friend. Profits are. Number one thing. Always try to end the trade in profit, no matter what. Because once you will put a habit of making profits, it will stick with you. This plan that I am showing you is made through sheer hard work with huge losses initially. And then I learned how to make a good trading plan. Now right here, it's dividend date. So the results would have come in. And then the price made a lower lows. See the first low, the initial lows, greater low was this. This is 1701. So this was the first day where it made a lower low of 1687. And then this was the second day it made far more lower lows. So always end your trade in profit. Number two thing. Beyond this and beyond this line are huge losses. So try to end your trade within this band, either on expiry or before expiry. That's the reason we traded it on the Bollinger Bands initially. Why? Because we knew it would start to contract. And once it contracts, it will give us a space in between. A space in between. Where we can simply square once the price goes beyond, we can simply square our trade and get to keep the premium difference. And that premium difference is our profit. So we are not risking, because we know if we would have not squared it and it would have suddenly fallen down, then on the next day we would have to share the losses, and they would have like gone down, 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 and our losses would have piled up. That's the number one reason for my plan, not to get a huge losses. Because if you look at it, it went down, down, down. Or like lower band was 1637, but here it's trading at 1424, 1331, and now it's coming up. No, going down. So that is the number one thing. Another thing to remember, most important, always try to initiate short strangle after a rise. What do I mean by rise? Right here, we saw the price was rising. Once the Bollinger Band contracted, we started our trade. This is a good time to trade. Number one, if the price came down, you could have squared it, but on the lower side, I won't recommend you short strangle. Reason being, once a fall happens, then the rise is usually really sharp. So if you trade the short strangle after the fall, then there is a high chance you may not end up in profit. So always try to create the short strangle on the rise, and always look, once the price goes beyond the Bollinger Band, just square it out and say it's enough. The number one thing. Now the thing to note, right here the price did went up. It went up, 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 then it started to contract. But the Bollinger Band was not contracting. So always remember, don't follow the price, follow the Bollinger Band. It's still going up. So the price should follow it and go up. Right here, it's 1575, 1573, 1564. 1, 2 days. This is the second day. So either on this day or on this day, you would have initiated your short strangle. Right? Let's say right here. The call option above the Bollinger Band and the put option below the Bollinger Band. Right? And we will wait for its contraction. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If you look at it, the lower Bollinger Band was 1298, but right here it's 1362. The top Bollinger Band was 1564, but right here it's 1524 on the 10th day. 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. Right here, our options would have expired. And we would have got to keep the full premium. The number one thing. Now, once you will be trading sometimes in like few stocks, and this is the number one reason that I suggest you to trade like really blue chip stocks, is that sometimes in like non-blue chip stocks, you won't find an option contract at this price. You won't find a put contract at this price. That's the reason I would suggest you to trade in only like huge volume stocks and big names. Because in big names, you'll find an option contract at every price, at all the prices. And therefore, it will be easier for you to trade. Because at the end of the day, you're trading for profit. Therefore, always trade like huge volume stocks. Don't trade smaller companies with small volumes. Never trade those. Trade huge companies, big names, because they will allow you to enter at any rate. And my plan is formed at specific points in time, at specific price points. You cannot trade it at any place you like, at any price you like. No, no, no. My plan is formed on specific prices. Example, these two prices are selected like with a full focus. If you would have made the price, let's say here, it would have given you like run for your money right here and those 4 days. If you would have increased it here, even though it would have not given you a run for the money, but it would have been sure like a hell ride, a problematic ride. So why take a huge risk? Why not trade easy money? I would suggest you trade only for money. I would recommend you, even if you can't find a stock for a month, no problem. The money that you have invested in the stock market is still yours. The full $1,000 that you have put in is all yours. But losses cuts your hard earned amount. And that's why I've chosen specific price points. I've chosen specific days for trades. I'm not telling you to trade each and every day of 365 days a year. No, no, no. You simply cannot. You simply cannot. And that's the point. My plan is designed for specific days, specific price points, nothing else. So if you want to follow my plan, follow it to the core. Otherwise, whatever changes you make, you will be responsible for it. Because I have designed this plan according to my huge research. Huge research. So please, please, please do remember this. Another important point is result season. If you look at it, let me zoom out. This is our first trade. This is the dividend. Usually our trading plan, the short strangle plan, comes nearer to like the result season. This was the result season. This was again the result season. We would be trading before the results. So on the news and everywhere else, you would be hearing the opposite. The price is really bullish. The company will be posting awesome results. The results are awesome. They have grown 100%. Their bottom line is 50% up. But don't confuse your game plan. Always stick to your game plan because the news will always be opposite. Because that's how the major people get trapped. They won't read the results that how the bottom line is 100% up. Because like they sold the inventory. They won't see if the company have like huge issues going forward. The common person don't know these things. He will only hear the least end of the news that the results are awesome. The results are in line of the expectations. This is not important. Important is your plan. And that's why I've made this plan after careful study. So please do remember it. Follow it to the core. Follow it on the specific date. If you look at it, I'm not trading out all the days. If you miss this day, then the time is like really limited. Then within like 3 days if you lose it, then this 15th day, the expiry would have come right here. Or here. So always be ready on that date. Don't miss the date. Because if you will miss it, your expiry date will start to move lower. Example, if you missed that we expired, let me show you, zoom in. The option expired right here, right? But what happens next? 1, 2, 3, 4, 5, it started to go down. So if you would have missed this date and you would have chosen this date, then your expiry date would have been here, even though it's still in profit. But my point is, it starts to go down further. So be ready on that date. Don't extend it, because by extending it, you're extending the expiry as well. And with that expiry, your risk is getting increased. And if you don't extend the expiry, then your premium get reduced. And therefore your earning get reduced. So always remember, the date and time is really important. The strike prices are really important. You cannot do hanky panky with it. Thank you.